As we pull up the live order book for Tesla here in August of 2026, the ticker is flashing around the $339.30 mark, locked in a tense, high-stakes consolidation zone after testing lows near the $300 handle earlier in the summer and reaching toward local peaks near $350. Turn on any mainstream financial media outlet, scroll through the echo chambers of retail trading forums, or listen to legacy automotive analysts, and you will hear a singular, deafening narrative. Tesla is struggling with compressed margins, a sluggish pricing environment in overseas markets, and an aging vehicle lineup that faces relentless commoditization. The retail consensus loves to obsess over quarterly delivery numbers, treating each production report like a referendum on the entire corporate entity, panicking when delivery growth hits speed bumps, and shouting from the rooftops whenever a discount headline drops average selling prices. But while retail investors are busy staring at the surface-level noise of car sales and fretting over short-term earnings per share, they are completely blind to the foundational physics and compute bottlenecks that institutional capital is actually accumulating into. The structural reality of modern equity valuation is that Tesla stopped being a traditional car company years ago, yet the market's mental models remain stubbornly trapped on the assembly line. While retail traders treat the vehicle as the end product, institutional heavyheads recognize that the physical car is merely a distributed edge computing node, a rolling sensor suite designed to feed miles into the world's most aggressive neural network training pipeline. The real bottleneck holding back autonomous transit isn't sheet metal stamping or battery pack casting. It is the sheer scale of the compute throughput required to process millions of edge case driving scenarios in real time. While standard automakers are bleeding cash trying to scale unprofitable EV architectures under crushing legacy debt, Tesla is quietly burning billions in capital expenditure to build out massive clusters of advanced AI hardware, the Cortex training infrastructure designed to clear the final hurdles of scalable, unsupervised full self-driving. When the market panics over a temporary dip in automotive gross margins, it completely misses the hidden inflection point, the software-defined subscription model scaling quietly in the background, where every new active subscriber represents high-margin recurring revenue that completely bypasses the cyclical volatility of the hardware manufacturing cycle. Market dynamics and institutional positioning. If you map the tape action over the past few quarters, the structural disconnect between retail panic and institutional accumulation becomes glaringly obvious. Daily trading volumes regularly oscillate between 25 and 45 million shares, punctuated by violent volatility spikes whenever macroeconomic jitters or interest rate anxiety sweep through the broader technology sector. During those sharp liquidations, such as the sudden sell-offs that dragged the stock down toward the psychological support floor earlier in the year, retail social media feeds are flooded with capitulation posts, panic selling, and short-term options decay as traders get routinely washed out by margin calls. Yet if you look underneath the hood at the institutional ownership data and block trade accumulation patterns during those exact same bloodbaths, a very different picture emerges. Mega-cap funds, quantitative asset managers, and long-term institutional allocators systematically step in at the bids, absorbing the retail float and quietly building massive multi-year positions. They are not looking at next quarter's delivery consensus. They are pricing in the multi-billion-dollar capital expenditure cycle projected for the entirety of 2026, viewing the temporary suppression of free cash flow as the mandatory price of admission for establishing an unassailable technological moat in autonomous robotics and AI infrastructure. They recognize that retail traders are trading the news cycle, while institutional algorithms are trading the decade-long structural shift towards decentralized energy storage and autonomous fleets. Before we dive deeper into the operational mechanics of this transition, let's pause right here. Are you currently holding a core position in TSLA through these macro swings, or are you sitting on the sidelines waiting for a deeper liquidity flush to build your stack? Business model and historical context. If you truly understand why traditional valuation metrics fail so miserably when applied to Tesla, you have to strip away the outdated historical framing that compares the company to legacy industrial manufacturers like Ford, General Motors, or even Toyota. For decades, the automotive playbook was simple. You amortize tooling costs over a 7-year vehicle lifecycle, rely on dealership franchise networks for service revenue, and pray that economic recessions don't crater your inventory turnover. Tesla shattered that paradigm by introducing a direct-to-consumer software over-the-air update model that treats physical hardware as a dynamic canvas capable of improving long after it leaves the showroom. But today, even that narrative is evolving past the single product dependency of the Model 3 and Model Y architectures. The business model has fractured into 3 distinct, high-growth pillars that operate on completely different economic vectors: high-margin software subscriptions, massive utility-scale energy storage deployments, and an aggressive R&D push into humanoid robotics and purpose-built autonomous ride-hail hardware. The energy generation and storage division, anchored by the commercial rollout of utility-scale megapacks, has quietly matured into a powerhouse cash flow stabilizer, posting deployment volumes that routinely shatter previous quarters and providing a resilient counterweight to automotive pricing pressures. Meanwhile, the software side, specifically the adoption rate of advanced driver assistance features and full self-driving subscriptions, is fundamentally altering the company's margin profile over the long term. When a significant percentage of new vehicle buyers opt into recurring software packages at the point of sale, Tesla effectively layers a high-margin SaaS revenue stream on top of a hardware sale, decoupling its profitability from the commoditized steel and aluminum margins that plague the rest of the global auto industry. Comparing Tesla's current enterprise value to legacy original manufacturers is like trying to value a cloud computing giant using the historical book value of a regional telephone utility. It completely fundamentally misjudges where the terminal cash flows are actually going to originate. Future outlook, catalysts, and risks. Looking out over the multi-year horizon, the investment thesis for Tesla hinges entirely on its execution across several high-risk, high-reward technological gatekeepers. The primary multi-year catalyst remains the commercialization of the dedicated autonomous ride-hailing ecosystem, the Cybercab network, and the maturation of the Optimus humanoid robotics platform, both of which represent massive step functions in total addressable market expansion. However, navigating this transition is fraught with severe operational hazards. The capital expenditure cycle required to fuel next-generation AI training clusters, advanced manufacturing lines for unboxed vehicle processes, and global battery supply chain integration demands intense, continuous capital allocation. Management is pressing forward with aggressive multi-billion-dollar annual capex plans, which places immediate pressure on free cash flow generation during periods when vehicle price wars in key international markets squeeze operating margins. Furthermore, regulatory hurdles surrounding unsupervised autonomy remain a formidable bottleneck. Navigating the labyrinth of state-by-state and international approval processes for fully driverless commercial fleets will test the patience of even the most convicted long-term bulls. Geopolitical frictions regarding critical mineral sourcing, battery supply chain dependencies, and shifting regulatory frameworks for electrification subsidies add layers of macro uncertainty that can trigger sharp sentiment-driven drawdowns at any moment. Yet for the disciplined investor, these very risks are what create the market mispricing in the first place.
The short-term price noise, whether driven by a missed delivery estimate, a margin compression headline, or a noisy regulatory debate, obscures the relentless compounding execution of a company transforming global energy distribution and physical labor automation. When you zoom out past the daily candle charts and the emotional noise of retail trading forums, the fundamental reality remains unchanged. Tesla is engineering the infrastructure of the future. Looking past the immediate volatility isn't just a strategy for surviving the current market cycle, it is the absolute prerequisite for capturing the asymmetric upside of the most disruptive technological transition of our generation.